Hey, everybody, what's going on? Welcome to another edition of Wealthy and Wise Wednesdays, where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today, I have a very simple question for you. Given all that's happened in the country this year, do you think it's possible that you're invested too aggressively or too much at risk in your retirement accounts? That's the question that I have for you. Is it time to take some of your winnings off the table? Is it time to lock in some of your profits? Now, I know what some of you may be thinking. Yeah, Ron, but I kind of want to, but things have been going so good in the stock market, and man, we could make 10, 12, 15% rates of return. Well, is that true? Is that what the average investor has been making over the last 20 years? And the answer is no. On your screen, I have the historical return of the S&P 500 over the last 20 plus years. From January 2000 to the end of August 2020, the S&P 500 has returned a whopping 4.378%. And if you had the guts to stick in there, even through the bad times, and not pull out at the wrong times, and if you had the discipline to reinvest all of your dividends during that time, the absolute best that you would have done in the S&P 500 is 6.357%. Now, I know some of you may be shocked, but Ron, Dave Ramsey says you can get 12% return in the stock market. Well, Dave Ramsey is a liar. Okay, he's a liar, just like a lot of these Wall Street guys, because what they do is they use Wall Street wizardry when it comes to their math. And I'm going to pull back the curtain and I'm going to show you how that new math works. Now, wait a second. Are you trying to tell me that you've never heard of the new math? Well, let me put an equation on your screen right now. When does negative 30 plus 43 equal 0? Now, you may be thinking to yourself, well, never. Ron, you're crazy. I'm going to teach you something right now. Old Mr. Sneller isn't crazy. Let's say, for example, you're one of the lucky people who retired with $1 million in your IRA. But unfortunately, the year that you retired, the stock market crashed. And let's say, hypothetically, it dropped 30%. So now you're down to what? $700,000. Pretty easy math, right? Now, let's say, for example, the next year, you're hoping that the market comes back. And what will we have to do to grow that $700,000 back into $1 million? We'd need to gain 30%, right? Not so fast. 30% of $700,000 is only $210,000. So if we gained a 30% return, that would only bring us back to $910,000. So actually, to get our $700,000 to grow back to $1 million, we would actually need a 43% rate of return. Negative 30 plus 43, that is your 0% rate of return. Now, let's say, for example, we had a really bad market crash and we lost 50% of our portfolio value. And by the way, this has happened twice in the last 20 years. So this isn't some kind of crazy, ridiculous scenario. But easy math, right? $1 million, 50% loss, our account balance is cut in half. It's down to $500,000. Now, what kind of return would we need to get that $500,000 back to $1 million? Now, you're probably thinking, there's a little bit more to this than meets the eye. It's not a 50% rate of return. And judging by the last example, it's probably like a 70 or 80% rate of return. 80% rate of return, Ron, final answer. And again, you would be wrong. You would need a 100% rate of return to rehabilitate or recover and move from $500,000 back to $1 million. Think about that for a second. $1 million, when you lose half of that account balance, you then need to double that account balance, right? You need to get 100% rate of return. That's doubling the account balance. For those of you who are retirees or pre-retirees, this actually gets worse for you because during retirement, where are you getting your income from? You're withdrawing from your portfolio, right? Now, let's say, for example, let's rewind back to the dot-com crash. And during that time, the S&P 500 went down 50%, but not only did it go down 50%, you exacerbated that problem because while it was down for 3 years, you were still taking distributions from your portfolio. So let's say, for example, you were taking out 5% per year, even during the dot-com crash, because you needed the money to live on. There was nothing else you could do, right? So during that 3-year period, you actually depleted your account 65%. So what kind of rate of return would we then need to recover the account balance back up to $1 million? Well, we would need a 175% rate of return, and that would be nearly impossible. Here's the scoop. What I want to teach you is that Wall Street tries to get you to focus on average rates of return, but average rates of return is a lie. What we want to focus on is account balance and the compounded annualized growth rate. The CAGR is much different than your average rates of return. For example, in year number 1, if you lose 30%, we're down to $700,000. And then in year number 2, we need to gain 43% to get back to $1 million. The Wall Street wizardry, that number that they love to quote, your average return. Well, wait a second. -30 plus 43, that's a 13%. Divide that by 2 years, our average rate of return is 6.5%. Well, wait a second. Year 1, we start with $1 million. 2 years go by and we still have $1 million. So how in the world is our average rate of return 6.5%? That's the Wall Street wizardry. And I'd like to put a little graphic on our screen created by my good friends over at Midland National. It's called the break-even burden, because what average rates of return do not take into consideration are the compounding effects of the losses. Every time that you lose 10% in the market, you actually have to gain 11.2% just to break even. Every time we lose 30% in the market, we have to gain 42.9% just to break even. Anytime we lose 50% in the market, we then have to gain 100% just to get back to even. Now, how long is that going to take? Let's look at a graph of the S&P 500 over the last 20 years. And so this is adjusted for inflation. And what you're going to see is that we have had, in the last 20 years, 2 downturns of at least 50%, where those downturns have lasted about 3 years, and then it took between 4 to 5 years just to recover. So during that entire time, you're spinning your wheels, right? And so if we are at all-time highs right now, and if you think that it's possible that you're invested too aggressively or you're too much at risk, maybe you're retired or maybe you're about to retire, doesn't it make sense to take some of these winnings off the table? Because what would happen if we see another big crash and we had to spin our wheels again for 5, 6, 7 years? What's that going to mean for you? How about the people, even if they're only 40, what if they have an old 401k that they're no longer contributing to? Does it really make sense to keep that money at risk, where if we see a huge market decline, that money is just going to sit there and spin its wheels? And not only is it going to spin its wheels as far as losing a bunch of money and then taking a long time to recover, but fees are also coming out of the account, even though the market's down, which just makes it longer to recover. So wouldn't it make sense to take that money out of the market, maybe take it away from risk and lock it into something safer? Now, look, the 401ks that you have, that you're currently contributing to, look, during these downtimes, that's the best time to have money going in, right? Because you're buying stocks at low prices. And that's where we let dollar cost averaging work for us. But these old 401ks that we're no longer contributing to, maybe it makes more sense to do something else. And if you don't believe me, let's take a look at some of these other statistics. A bear market occurs approximately every 5 years. The average decline is 39%. The average duration of a bear market is 1.5 years. even though in the new millennium, it's been about 3 because it's just getting more and more volatile as the Fed tampers with money. But that's an aside. The average time to break even, 5.2 years. So looking at the last 20 years in review, we have had some good markets and then they have been decimated by crashes. But over the last 10 years, we have seen an incredible bull market run. Is it going to last forever? I don't know. But I do want to circle back to my original question because nobody has a crystal ball. I cannot predict the future, just like any other investment advisor can't predict the future. Again, the answer comes down to your personal preference, where you're at in your life, your risk tolerance, your time horizon. Does it make sense to take some of your winnings off the table? What if I could show you a way to put your money into an account where when the market had good years, we could credit you almost double-digit rates of return. But when the market had declines, you wouldn't lose a penny and all of your gains would be locked in. And then you wouldn't spend years trying to spin your wheels and chase just to get back to even. Would that make sense? Would it make sense if you had a safe place to store your cash that paid 3, 4, 5 times higher rates of return than what you would get in a savings account, a money market, or CDs? There are accounts out there that can do that for you, where we can take the risk completely off the table, but still keep you in position to take advantage of the good times. If this is something that interests you and you want to find out how to position your financial life like this, give me a call. 248-499-9676, extension 1. Let me help you keep your money safe and protect you from all the bad things that could possibly happen, but also keep you in position to take advantage of when the good things could happen. Well, that's my rant. Thanks for listening.